Yeah, I think the first issue is for the co-beneficiaries to acknowledge they are co-beneficiaries. And I think you're seeing the insurance industry largely in the spotlight on this. Most recently in California with wildfires. I think people are rightly asking the question, why aren't there more incentives for us as homeowners or building owners to do the right thing? And you're seeing various regulatory proposals. For example, the insurance commissioner for California is looking at mandating insurance discounts. And the insurance industry probably looks at that quite skeptically because the insurance industry is already saying we underwrite according to risk. And if the risk is high, the rate is going to be high. If the risk is reduced, it will be reflected in your premiums.
Hello, and welcome to this special episode of the REIT Report, part of our 2025 Building Resilience series, which will cover how the REIT industry is investing for the long term using market solutions to create the communities of tomorrow while staying focused on the challenges and opportunities today. I'm Jessica Long, Nareit's SVP for Environmental Stewardship and Sustainability. This episode is part of our first series, which will include 3 guests discussing how REITs are on the front line in addressing the increasing complexity of physical risk in the built environment. Buildings must not only be physically resilient to the increasing frequency and severity of natural disasters, but also maintain comfort and safety for the building occupants and connected communities. A building's resilience impacts many stakeholders who depend on REIT-owned properties to shelter homes and businesses, provide essential services like groceries and medical care, and provide the digital infrastructure that connects everything we do, just to name a few. REITs own income-producing properties, and quantifying the financial benefits of resilience is challenging. REIT shareholders and other financial stakeholders, banks, insurance companies, municipalities, and bondholders are invested in the value of the building over the long term, and they depend on financial performance metrics, credit ratings, and increasingly on climate risk data to make decisions about allocating capital and valuing real estate assets and portfolios. For today's episode, I am pleased to have Daniel Kaniewski, Managing Director of the Public Sector at Marsh McLennan. Prior to joining Marsh in 2020, Dr. Kaniewski was the second-ranking official at the Federal Emergency Management Agency, known as FEMA. And as the agency's first deputy administrator for resilience, he launched and led the disaster resilience program that are now a cornerstone of FEMA's mission. Dr. Kaniewski was Special Assistant to the President for Homeland Security and Senior Director for Response Policy in the George W. Bush administration, where he managed over 200 presidential disaster declarations at the White House. Dan began his career in Homeland Security as a firefighter and paramedic and launched the global resilience practice at leading catastrophe risk modeling firm, directed resilience programs at DHS Research Center, and co-founded a Homeland Security think tank. Dan, we're really happy to have you here on this episode, and welcome.
Thank you, Jessica. It's great to be here.
So I thought we'd start out, what an amazing bio you have. Can you share a little bit with our listeners on your focus on resilience throughout your career and your current role at MMC?
Yeah, you mentioned I started out as a firefighter paramedic, and in that role, I saw firsthand the destruction, whether it be from the everyday disasters, car accident or a house fire, to the big disasters that I saw later in my career, like during Hurricane Katrina. I was at the White House and I saw the mass devastation from those catastrophes. And I said, shouldn't we be doing something ahead of time to reduce these disaster losses? Shouldn't we be doing something to protect Americans against the disasters they almost inevitably will face? And what I found was there was a small but growing interest in an area called disaster resilience. That area grew over time. And as I saw over my career, as we entered, let's say, 2010, I found a small group of us, specifically as emergency managers, who were interested in that pre-disaster actions that can be taken, frankly, by a local government, can be taken by a state government, the federal government, or like all of us, homeowners, business owners, communities. And that really drove my passion forward to the point where I got to lead these programs at FEMA.
That's amazing. And I know a lot of our listeners are sustainability leaders who have worked in real estate for a long time and really see similarly how taking steps, taking action ahead of time, and really being able to identify certain risks and opportunities and then move them forward are part of the career paths that many folks in this space have followed. So one of the things that you do that I'm excited to talk about today is you have a chair of a council at the National Institute of Building Sciences where you worked on a resilience incentivization roadmap. I'm really excited to talk to you a lot about some of the what's in that study. But can you share a little bit about again your role on that committee in your current capacity and the impetus for creating that study?
Sure. In a pro bono role, I chair the Committee on Finance, Insurance, and Real Estate at NIBS, or the National Institute of Building Sciences. I first got to know NIBS years ago when they had done a study that showed for every $1 the federal government invested in hazard mitigation, in other words, risk reduction measures, it saved $4 to the federal government. That's a great statistic, and it showed really the value of hazard mitigation for those emergency managers that were contemplating taking those actions. Fast forward, I found myself at FEMA in 2017 on the heels of hurricanes Harvey, Irma, and Maria. And the questions policymakers were asking us were, how can we prevent this from happening again? Both the destruction to those homes and those communities, as well as the losses, the financial losses to them, as well as to the federal government. And about that same time, NIBS was doing an update to their study. To the study's called Mitigation Saves. And what they found was, and I may have pushed them a little bit on this at the time in 2017 to give us what was going to be the bottom line. I know you're going to produce a 300 or 400-page report, but is it going to be as good, as strong as that 4-to-1 number? And in fact, they shared the news with me. It was 6-to-1. So in the updated report, they found that there were others who were benefiting from these mitigation investments beyond just the federal government. There's communities that can continue to function after a disaster, will save money not just to the homeowner and not just to the federal government, but to everyone in that community that would otherwise have to take the time to help those with the losses. So it was the response recovery costs were greatly reduced by those hazard mitigation investments. And so that's how I first got to know NIBS. And when they invited me to more formally be part of their organization, which is a congressionally chartered nonprofit, by the way, when I joined the private sector, they and I found the nexus with insurance because I'm currently at Marsh McLennan. We're the largest commercial property and casualty insurance broker. And when they said, hey, we have this committee that we think you could chair because there's insurance as part of it, that was really very much of interest to me. So I would think of myself as one, as the insurance guy who works with these engineers and these physical scientists at NIBS and provide that other perspective. But more broadly, the Committee on Finance, Insurance, and Real Estate, exactly what it sounds like, brings in not just the insurance industry, but in fact, many of the stakeholders that I know you and your members care deeply about as well.
And these stats are amazing. I read the 4-to-1 number in the study and then going even further to look beyond the federal government savings to the actual stakeholders. And so I think a lot of folks, it makes total sense, right? You make the building more resilient, you're going to save in the event of a disaster. But I think what the paper really goes into is this idea of what we call the split incentive on the energy side a lot around the building landlord is paying for the upgrades, but the tenant is getting the energy cost savings. And I think in the resilience space, it's really going even further, right? If a building owner invested in making the building more resilient, there are all of these other folks that are gaining that benefit. And so can you talk a little bit about this concept of the co-beneficiaries of the resilience measures and how you came to build the report around that idea?
Absolutely. And yeah, the report, it's the Resilience Incentivization Roadmap 2.0. You can tell that name was not developed by marketing experts, but by engineers, which is fine. But it says what it means, right? Well, engineers are always very clear on that. And so we sought out to say, how can we incentivize stakeholders to invest in resilience so that the full cost of a resilience measure isn't fully borne by any one individual or any one stakeholder? Because as the term of art, as you mentioned, is co-beneficiaries. We know that there is an array of beneficiaries when it comes to that resilience investment. We mentioned it a bit by saying, yeah, if the homeowner makes the investment, then the local government benefits because they're not going to have to expend emergency response resources to help because the house will still be standing and the state won't have to respond. The federal government won't have to respond and they can focus their response assets elsewhere. But it goes much deeper than just response assets. It's actually a whole ecosystem of co-beneficiaries that we identified. Everything from the real estate industry to the insurance industry, obviously in the finance industry, which is why our committee focused on it. But looking specifically within our industries and the finance industries, the lender is going to benefit because there's less likely to be delinquencies or bankruptcies associated with those business or home losses. And thus, there'll be fewer losses to the book, so to speak, of that lender. And so the lender benefits, and very intuitively, the insurer benefits, right? I think we can all wrap our heads around that fewer losses should mean to that homeowner also means fewer losses to that insurer. But then the question is, how can they, if we've identified those and others as beneficiaries, how can they then incentivize the building owner, commercial or residential, all the way down to the homeowner? How can we incentivize them to do the right thing? We know, again, intuitively, insurers would offer lower premiums. And again, that makes sense because if there's fewer losses, the premium should be lower. And oftentimes what's mentioned though, and I have to just say this as a caveat, and I work by the way, at a broker, right? So I'm not at an insurer, but I know something that drives the insurers nuts is to say, okay, well, give me a discount or pay, or even worse, pay for this mitigation measure entirely, because I'm going to save you, the insurer, money. Well, yeah, true. There will be some savings to the insurer, but not 100%. Because going back to the earlier point, the loss averted benefits an array of those stakeholders. So what the insurance industry would say, we need the lenders to step up. We need the local government and the state government and the federal government and all of these stakeholders together. If they were to, one, acknowledge that they are beneficiaries of that investment, which is step one, and step two, then provide a incentive to that homeowner, that building owner, to do the right thing, then I think we get somewhere, right? Because if each of those stakeholders, each of those co-beneficiaries puts in a little, pretty soon it'll have a dividend for all and potentially pay for that mitigation measure or at least incentivize enough, provide enough incentive for that homeowner, the building owner, to take that action. The same applies also before the building is constructed. In fact, that's the best time to have this conversation, is before there's any type of construction, because retrofits are relatively expensive, especially compared to new construction. So if these conversations are happening among a developer and an investor and a potential future owner of that building, then there you can really see where this makes a lot of sense, because for a relatively small amount of additional investment, you get a lot of bang for your buck.
Yeah, and I think this idea of incentivization, again, we've spent a lot of time in the real estate sustainability space talking about energy efficiency, and we've seen that. I'm here in Maryland. We have a program called Empower Maryland. We all pay in LED lights, building insulation. There's a lot of things that then are offset. The cost is offset to the owner by the collective beneficiary, or the idea that you can move these things forward. A few of the recommendations of the study go into a few examples of ways that you could get some of these programs moving. I think there's a lot of ideas contemplated as far as spreading the cost among the co-beneficiaries, but really moving that idea into the market. What are some of those examples, or what are the things that you think that kind of are some of those next steps?
I think that depending on the stakeholders, there's different levers they can pull, right? So if we're talking about a lender, it could be lower points or lower interest rate on the loan, again, to reflect the benefit that lender is receiving. To the insurer, we talked about that. Obviously, I wouldn't say discounts. I would say a lower premium, because ultimately what insurance is a reflection of risk. And if your risk is lower, then your premium should be lower. The government agencies provide some pretty obvious incentives. They're called grants, right? And so I think the federal government's grants, again, the reason this whole study was even done was to look at what's the return on that investment for those federal grants. So that's pretty clear. But what I think most don't realize is that there's grants that various states provide. There's about a dozen states that provide grants for homeowners to retrofit their roof, for example. And a roof retrofit is simply replacing a roof with a newer or stronger roof, one that ideally meets the IBHS fortified standard. IBHS is the Institute for Business and Home Safety. And their standard, which is called fortified, is exactly what it sounds like. It's a stronger way to construct a roof. And if you do that, for example, in the state of Alabama or in other states like Florida and Louisiana that have very similar programs, then not only do you get that government grant to help you pay to replace your roof with a better one, but you're also likely to see reduction in your insurance premiums, because your insurer is going to give you credit for what you do. And again, the credit you're receiving from your insurer is not meant to pay for the purchase, but it's an example of where co-beneficiaries are coming together, where the state government sees a benefit and the insurer see a benefit, and together they're giving enough incentive to get that homeowner to make that investment. And in fact, there are other benefits to resilience beyond just the cost savings. I know we often focus on that. But number one, we should never forget that it makes the home or the other structure safer, right? So you as the building occupant will be safer as a result of those measures that were put in place. So the losses averted is also losses in human suffering and human life, which is the first reason we should be doing this. Then there's the cost reduction. But here's another, maybe an unexpected finding, is that it also makes those properties more valuable. And I think we can intuitively understand that if it's more resilient, there'll be more demand for that type of structure. It also means it should sell when it does sell in the future for a higher price than it otherwise would have. But now we actually have empirical evidence of that because of work done by the University of Alabama in coordination with the state of Alabama that put that retrofit program in place. We now know that homes that are constructed to that fortified standard that received those grants to do so, that they are seeing reduced insurance premiums and higher sales price than they otherwise would have. So these homes are more resilient and the homeowners are paying lower insurance premiums and seeing higher resale values. That's incredible. That's a win. You can keep saying win like 5 more times probably if you look at all the co-beneficiaries from those investments.
And that's a really interesting case study. And I think that idea that it revolved around a standard and that everybody came together and agreed that this standard would create the results and therefore you could make the leap to the financial benefits. Because again, like when you're looking back at the savings, you say, okay, they were able to save, but somebody had to make that decision, right? Somebody had to say, okay, they've checked these boxes and now we're going to take a risk and say we're giving them a lower premium to reflect that benefit that's going to come from the increase. One of the things that is contemplated in the paper is the idea of a flood risk certification. In the building sector, we have a lot of experience with building certifications. And so I wanted to talk about that a little bit because I think there is an important role for standards and certifications to give that confidence to decision makers to say, I am going to adjust the numbers based on this reduced risk and have a little bit of backup to support that decision making.
That's right. The reason that we, by the way, focus on flood, so the focus of that report, we couldn't do everything, all the perils, all geographic areas. So we said, you know what, we're going to focus on flood because flood is the most common and most costly natural disaster. And we know that every region in the country experiences flooding in one way, shape, or form. So it's unfortunately quite ubiquitous. Now, what I would say is there are multiple ways to deal with any of these perils. And I generally bucket those under kind of 3 areas. I'd say preparedness, hazard mitigation, and insurance. And think of those as 3 legs to a stool. And if you don't really have all 3, that stool gets really wobbly. And that stool I would call resilience. So you've achieved resilience if you've met all of those 3 criteria. For hazard mitigation, for flood, in the most extreme scenarios, that's buyouts. That's moving entire communities. But short of that, it's elevation. And so elevation is unfortunately quite expensive. It's not only costly, but time consuming. And it makes it rather challenging to fully mitigate a hazard. There are other measures that can be taken. And oftentimes it's at the community level. So you think about it, like if a community works on this together and says, we experience flooding in this area consistently, time over time, here are some community level investments we can make. It could be as simple as a flood wall or a way to redirect water away from that area of the community, this low-lying area. And that community coming together and making that decision provides a collective benefit to that community. And in doing so, it not only protects those homeowners and business owners from flooding, it also provides them with more affordable insurance coverage, for example. And so flood insurance, as we know, can be quite expensive in the high risk areas. And the way to address that is to attack the risk, right? And attacking the risk could be that community level, or it could be the individual homeowner or business owner taking that action. And ideally, it's a combination. As much as I would love for there to be a one-size-fits-all approach to this, there isn't. This is a homeowner and business owner decision, and ideally a community-level decision. Standards have a role to play here, obviously. There are many good standards that the construction industry can follow and should follow. But I would say more broadly, again, to make an example at the community level, would be building codes and zoning laws. If you have a weak building code or ineffective zoning laws where you're permitting construction in high-risk areas, I would say the community is not doing anyone any favors, but in the context of incentives, they're providing the wrong incentive. They're providing like this disincentive to do anything about resilience. So some of these measures, again, are at the property level and some are at the community level.
That's interesting. And the more you talk, the more I think about just the idea of this need for collaboration, right? No one of these groups is going to solve this on their own. It really has to be a full stakeholder effort to move it forward. And I like what you just said as far as if somebody is building a not resilient building in a community, it could actually impact the costs for that whole community, even if you are in a more resilient location or have made the upgrades. And so it's that collective effort to be more resilient, affecting everybody.
For better or for worse, the example to use is wildfire. For wildfire risk, it's as much about what your neighbor does and what your community does as it is what you do to your home or your building.
Yeah, that makes a lot of sense. And I think we're learning a lot about wildfires with the disaster that unfolded earlier this year at the beginning of 2025. The survey gets into this idea of willingness to pay. I think that's a really interesting concept. And it reminds me a lot of conversations we have a lot, again, with the investment community to say, we know it would be great to have all of these sustainability features in every building, but what are the features that you're willing to pay for, both from investors and tenants, I think is almost a more common conversation to say, again, like nice to haves versus need to haves. And so, can you talk a little bit about just this idea of really being able to quantify resilience benefits that can increase the value and have this increased value associated with it?
Yeah, I think the first issue is for the co-beneficiaries to acknowledge they are co-beneficiaries. And I think you're seeing the insurance industry largely in the spotlight on this. Most recently in California with wildfires. I think people are rightly asking the question, why aren't there more incentives for us as homeowners or building owners to do the right thing? And you're seeing various regulatory proposals. For example, the insurance commissioner for California is looking at mandating insurance discounts. And the insurance industry probably looks at that quite skeptically because the insurance industry is already saying we underwrite according to risk. And if the risk is high, the rate is going to be high. If the risk is reduced, it will be reflected in your premiums. And with wildfire in particular, it's very hard to determine exactly the value of each individual measure you can do to reduce wildfire risk. Now, it's not like that with all perils. In fact, I'm intentionally choosing the most complicated here, which is there might be a dozen things that you could do to your home or your structure to reduce the wildfire risk. What if you do one or two of those things? What if you replace your windows or your garage door because those are vulnerable elements? Great. But if that's all you do and the home still burns to the ground, I think the insurers would look at that and say, yeah, that's why we don't give discounts for just these onesies and twosies, because it's the outcome is still the same. And so I think you have to look at this holistically and say, what can that owner of that structure do to fully protect it as best as can be done against that peril? Let's say wildfire. And here it would be a half dozen or a dozen things you do. So it's not just the windows and the garage door, it's the roof and the building materials, the defensible space, 5 feet around. So all of those things together, I think then, again, we're not an underwriting organization, but if I were an underwriter, I would say, now I see that risk is substantially reduced because no matter how those embers land and no matter how this fire hits the structure, it's going to be relatively resilient against that wildfire risk. And therefore, I'm going to reduce the premium because the risk is now reduced. And again, like we said earlier, with wildfires, not just the structure. It's, again, what does the neighborhood look like? What does the community look like? And those will also factor into the underwriting guidelines. So again, in some cases, it's quite straightforward. In some sense, the easiest example is those roof retrofits that are common in the Southeast U.S. because we know through a lot of data and a lot of analysis that IBHS has done in their facilities over the year, we know the benefit of replacing that roof, right? You can compute that and it will be reflected in your insurance premiums. But with others, the more complicated ones like wildfire, it's not quite as easy to quantify each measure, but it is potentially quantifiable in a more holistic sense.
I mean, that's so interesting. And it again reminds me of experience that I've had in my career with green building certifications, where again, you could have these, what we used to call random acts of sustainability happening in the building. But if you're not bringing it together to say, we're doing all of the things to make the building more sustainable, or healthy buildings is another area where have some experience kind of pulling these things together into a stamp of approval, a certification that says, yes, you're doing all of the things, and the concept of having prerequisites as part of that, as well as points and value assigned to building location and things that are in the surrounding community. As you can tell, I'm a big fan of that strategy. And I think just one of the things that I talk a lot about is the ability to easily communicate that to a stakeholder rather than having to rattle off a laundry list of technical terms. And also going even a step further and thinking about the industry that we live in that largely revolves around data, the ability to quantify and to say LEED certified buildings are commanding a higher rent. And looking back, we have more of that data. And the certification itself is one of those key data points that allows us to start to build that case that there is the benefit. And I think that unfortunately, the more we get down the road with more frequent and severe disasters, the more data that we're going to have and the more information we'll have to make the case. So I guess one of the key things that I think is talked about in the study leads to that ability to communicate and talk about this is raising public awareness about the financial benefits of investing in resilience. You mentioned just acknowledging that you're a co-beneficiary, but also raising awareness about some of the clear benefits, as you mentioned, financial and human health and safety.
That's right. And I'm going to sound a little bit like a commercial here for both NIBS, again, nonprofit that I'm affiliated with, as well as IBHS that I keep mentioning, because they have the standards, the consensus standards that we in the insurance industry look to when we're thinking about a resilient structure. And IBHS, a nonprofit actually funded by the insurance industry. We are funding them to test building materials, right? And to come up with what are these comprehensive approaches, which is their fortified standard for wind, for example, then also now have for homes vulnerable to wildfire, as well as to communities vulnerable to wildfire. And so the first thing I would suggest, if you were a homeowner or business owner, is go to IBHS and pick your peril and see the steps you can take to make your home more resilient. And it'll sound familiar here because it's going to be preparedness, it's going to be hazard mitigation, and it's going to be insurance. You need all three of those things, no matter if you're an individual homeowner or a commercial business owner. There are guides that can help you understand what you can be doing. And if you want to get the gold star, you can build to a fortified standard. Again, that's going above and beyond. That's for those owners who want to do something to make their structure more resilient, to make the occupants safer, and to reduce their losses in the future. Now, if I were an investor or if I were a developer, if I were looking at a property, one, I would care a lot about where it's sited and look at the risks that are associated with that particular area and that particular plot. Two, I'd want to make sure I consider the building materials I was going to put into that structure. And I would want to consult experts. Now, obviously, that would be on the construction side, and architects and engineers, but it's also make sure you consult your insurer. And ideally, you have a broker, right? If you're a commercial property, you're likely to have a broker. And you should look at that broker as your trusted risk advisor and not just as someone you buy insurance from. And what I mean by this is before that building is ever constructed, have that conversation with your broker to get guidance on how best to build that structure and how best to make sure that you can receive insurance, right? So make sure it's available based on where you're building and how you're building. But ideally, make it as affordable. And if you're an investor, you care a lot about this, right? Because you want your insurance expense to be minimized. And the best way you can ensure that, no pun intended, is to have that conversation before the building is ever constructed or ever purchased or retrofitted.
Yeah, over and over, I think timing is key. We talk about this in all elements, areas of sustainability. And anytime you're thinking about capital investment in a building, it's really, on a cycle and understanding where the right point in that cycle is going to be to make the investment. And anytime you can do that up front, I think is key. This has been so great. I think one of the last things that I'll just ask you to touch on a little bit is in the resilience incentivization roadmap talks about some opportunities for pilot programs. So what are your thoughts? Can you go through a little bit of these pilot opportunities and maybe spur some ideas for some of our listeners that might be interested in getting some of these ideas going?
Well, I know our intention in doing this report wasn't just to put out thought leadership. It was actually to spur action. And I'm so gratified to hear these ideas being put in action. So that's really heartening to hear that. Ideally, these would be pilots, right, that all of us are aware of, meaning that NIBS has a hand in and can be part of the learnings that are taking place when these co-beneficiaries are arrayed and actions are taken. And these actions, they can be very tactical. They can be very community-based. It doesn't have to be a nationwide effort. That would be great. That'd be great to see that. But it could be in your local community or with even just a particular site where these co-beneficiaries have come together in a way that incentivized that investor, that developer, that building owner to do the right thing. And I know that NIBS would love to hear about that. And moreover, I know that companies like ours are always testing new and innovative methods. One way that my company is testing ideas is through parametric insurance. If you've never heard of that, it's something that I would suggest it's something worthwhile learning about and asking your broker about, because parametric insurance, which essentially just means if a particular parameter is met, in this case, let's say wind speed, if a certain wind speed is met in a particular area, then there's an immediate payment, right? There's no insurance adjusting and the payment is immediate. That has a lot of benefits, and it's not necessarily meant to be an exclusive type of insurance coverage for a building, but I think it's part of the overall solution to what we're seeing in these areas that are increasingly having a hard time finding insurance at a rate that they want. And the reality is it's not the insurance rate, it's the risk. And so together, I think we can reduce risks. And I feel strongly about this from my company as well as the insurance industry, that we want to be partners in this to help reduce risks, reduce losses, and we all benefit. And I think if we can take that further and include all those co-beneficiaries we've talked about, the whole ecosystem of co-beneficiaries, that would be amazing.
Thank you so much for joining me today and having this conversation. I'm excited to hear from our listeners on their ideas and what they've learned and ideas that they have and projects that they have going, and continuing to work with you and NIBS to move this conversation forward. So thank you.
Thank you, Jessica, for having me.
If you enjoyed this discussion and would like to hear more about what's happening across the REIT industry, you can subscribe to the REIT Report or leave a review wherever you access your podcasts. If you're interested in learning more about REIT sustainability, check out nareit.com/sustainability, where we highlight efforts across the REIT industry to deliver strategic value through sustainability in the built environment.